Thank you for attending uh, the webinar today. My name is BC Clark, and I'm with the Nebraska Enterprise Fund. And we do collaborations all the time, bringing education to small business owners. And my speaker today is Jacob Malousek. I think I have a frog in my throat. Jacob Malousek with Ark Financial, excellent person that will talk to you today about finance. And I'm telling you, you will be delighted. Now, at the end of this, if you can hold all of your questions, he will answer those at the end. So just make a note of all of your questions. The Nebraska Enterprise Fund is a community development financial institution. We provide training such as these type today that you're going to see. We do a lot of technical assistance, and we also do loans. QuickBooks is something that we're very heavy on, and so you'll see those workshops. You can just go to our website at nebbiz.org, and we can talk more about that at the end. At this point in time, I'm going to turn it over to Jacob, and thank you, Do Space, for allowing us the opportunity to present. Thank you so much. Jacob.
All right. All right, awesome. Thanks, BC. And I also just want to give thanks to Nebraska Enterprise Fund and Do Space for making these educational opportunities available to you. Now, one thing that we're going to do, I'm going to go through just a little bit of a presentation here. Towards the end of this presentation, we'll have a question and answer session. And then at the end, I am also hopefully going to have the ability to send everybody a PDF file where they can take all of this kind of nerdy stuff that we're going to go through today and be able to digest it through a workbook that we created for this series. So a little bit about what I think we should use this floor to talk about today is in our business, it's important for us to think about our financial ratios. And more importantly, kind of this concept that we talk about is like these days of. So what I mean by that is how many days of cash do we have on hand? So if I was to stop bringing in cash today, how many more days could I go with what I have on hand? How many days of inventory do I have on hand? And what does that say about my business? What I have available for my customers? Do I have too much stuff available for my customers? Not enough stuff available for our customers? How many days of receivables do you have on hand? So that money that your customers owe you, how much of that is sitting out there? And we can kind of go through and do some analysis on that to see how we're positioned. Now, for those of you, if you're a small, medium-sized business, a lot of times we never really gave this stuff a whole lot of thought. And in fact, you know, this topic is almost maybe even a little bit more just like academic in terms of, you know, we would certainly talk about this in a college lecture setting. If we're a Fortune 500 company, we would be talking about this in our annual report, different things like that. But for a small, medium-sized business, it just really didn't occur to us to really think about this that much. And then what happened was, as we know, almost about a year ago right now, COVID hit Nebraska. And all of a sudden, this kind of became the topic that this was basically all that we were talking about in a business. Because before we would talk about margin, we talk about profits, and we would talk about debt, and we talk about equity in a business, but we never really focused on like, okay, well, what's the pulse of my business? What's my financial health? It just didn't occur to most business owners to talk about that. However, again, when that pandemic hit, that's all we were talking about. And so the example that I give all the time now when I'm speaking about this is that we had a lot of restaurants that we worked with, and immediately profitability took a back seat to survivability. Are we going to make it through this pandemic? And so that took this back seat to it. And so what happened was in those early days, and again, this was almost a year ago, if we can believe that we've been in this period of time, in those early days, you know, when we're sitting down across the table from a restaurant owner and we're starting to figure out how long can you survive? How many days can you survive your business without a dollar coming in before you're done, before we're bankrupt, before we're out of business? And we looked at that. We calculated it, where we're at, and then the goal just became of How do we make that number bigger, right? Because before, if your business was a growing concern and it was profitable, essentially you knew that you could be in business forever. But when all of a sudden things changed in your business, we weren't sure that we could be in business forever. So how many more days could we be in business? And then our goal was just to keep making decisions to increase those numbers of days that we could be in business until ultimately most of those restaurants are now back into that infinite setting to where, hey, with the way that business is running, we can make it because we're profitable and we have positive cash flow and the world is going really, really well. Now, in order to start wrapping our mind around this, basically what we have to do in our business is we have to understand how much cash we have on hand. Now, from a nerd like myself, an accountant, we talk about cash, and a lot to the average person, when we say cash, we're actually thinking about the green bills that might be sitting in your desk or in your wallet. It's not necessarily what we're talking about. We're talking about the money that's sitting at the bank, right? So it could be cash that you have sitting on your desk, but it would also be what's in your banking account, what's in your savings account, so on and so forth. Or sometimes we'll talk about cash equivalents. Those are things that we can turn into cash really, really quickly. Some examples of that might be accounts receivable. We might be able to turn what your customers owe you into cash within the next 30 days. So we might include that in our cash equivalents. For some businesses that sell merchandise, we might take some of that inventory value that we know that we could sell in the next 30 days, and we might treat that as a cash equivalent to start to figure this out. So if I'm a business owner, I want to understand how much cash I have, right? So if your books are up to date and you've got an accounting system, that becomes pretty easy for us to do. We would just simply look at our balance sheet. So, I'm just using as my example here on the screen I'm sharing here. Let me make sure that I am sharing my screen. Got it. So one thing that I would do is I would just look at my balance sheet. And I would look at that balance sheet as of today. And essentially what that tells me is here's how much money I have sitting in my different checking accounts. Here's my accounts receivable. And if I had any inventory on here, I could maybe count that as well. So essentially what I'm going to do is I'm going to add up the amount of cash that I have and how much of this accounts receivable I think that I'm going to be able to collect in the next 30 days. So these don't have to be like hard and fast numbers. I mean, we can be kind of, a little bit of a guesstimate on this. Well, let's say that I believe that 50,000 of this is going to come in the next 30 days. So essentially I have close to $300,000 worth of cash. So I would say if we were this business and we were entering a pandemic, probably more than likely we're in a good cash flow state, but let's go check that. So that's how we determine how much cash we have on hand. We're just adding up our checking accounts, our accounts receivable, what we think we're going to collect in the next 30 days. And that's basically the cash that I have to deal with for the next 30 days. Now, what I need to understand is how quickly do I burn through cash? So how quickly am I going to spend that cash? Again, this is the benefit of us having up-to-date books, because what I get to do is I just get to go look in my books and I can see on average how much cash I burn through in a year, in a month, or a day. And so essentially what I would look at here is if I just look at my profit and loss report, and I might look at this for last year. And what this profit and loss report does is it tells me, hey, here's how much income you have coming in. Here's your cost of goods sold. So if you sell a widget, here's how much that widget cost you. So if you're a restaurant, what was your food cost here, right? And then I have all of my expenses. So all of my overhead expenses. And I come down here to where I have my total expense line. And so essentially what this does is this gives me my overhead expense. And so what I need to do is I need to know how much money do I spend on my overhead. So rent, salaries, interest, insurance, all of those things. How much do I spend each and every day? So here's how that math kind of works. So I'm looking at this profit and loss for a year. You might look at it for a month or a couple of months, but essentially what you do is you just add up the number of days that those expenses turn into. So I'm kind of looking at this, and here's how I'm going to do that math. I know that my overhead expense for this particular company is $137,000. So I take $137,575, and that's how much it was for a whole year. So 365 days. So I take that divided by 365. I know that if I don't have a customer coming in through the door in my company, I'm going to spend $376 just on insurance, rent, all of that stuff each and every day. So then what I do is, I'm not going to use our real numbers here, but let's just say that I had $10,000 cash and I divide that by my 376. That might be a more realistic example. So what I did is, I know that I have $10,000 cash on hand. Let's make it more realistic for a business this size. And I know that I spend $376 on my overhead each and every day. So if I take that and I divide it by that, what that means is the number of days of cash that I have on hand is 26. So essentially what that means, if we think about it, is that if you don't have a customer walk through your door and you make no sales, 26 days from now, you're going to run out of cash. Okay. So after we've taken all of those cash equivalents, you have 26 days to survive. Here's the crazy thing about that, is that even in this example, I would say that if we were to do the law of averages, this company's pretty healthy, right? So we have 26 days worth of cash on hand. What we actually find a lot of times is that there are businesses that might have either just a few days of cash on hand, maybe it's 5 days of cash on hand, maybe it's 10 days of cash on hand. There's still times where we see businesses that have negative days of cash on hand, right? So they're floating checks out with the bank and they might have a negative number of days of cash on hand. So pre-pandemic, what we used to tell businesses is that, like, if we were just kind of doing a rough calculation on this, if we were to even do it, we would tell businesses, hey, let's strive to get 45 days of cash on hand. So again, we could figure out what that number needs to be. If my overhead is $376 a day, and I wanted to have 45 days of cash on hand, well, your average checking account balance should be $15,000 in order for you to kind of have some margin in your life if something unexpected was to happen to you. Now, post-pandemic, or during the pandemic, we're not post-pandemic, but during the pandemic, we started to look at that and say, gosh, I don't know if we were conservative enough on that number. And so what we've been telling businesses now is, hey, let's see if we can get 60 days of cash on hand. That way, something happens, we have some flexibility to handle it, to be able to continue to pay our staff, to continue to do all of those different things. And so what that looks like is, again, if my daily nugget, sometimes is what we call that, is $376, so what my overhead expenses are, again, every day, I just take that times, wherever we wanted that to land. So if it's 60 days, 65 days, somewhere in there, that's going to tell us how much cash we need to have on hand, $22,000. So you can see that we went from maybe that less conservative model saying, hey, you need to have $15,000 cash on hand in your business, to $22,000 cash on hand in your business. And I know what a lot of small businesses might be thinking. Well, that's great, but how do I get there? Like, how do I, I'm suffering through the pandemic. I've got my business is taking a downturn. How do I get there? How do I get that much cash on hand? doesn't happen overnight, right? So what we will typically tell a business is, let's just take some baby steps here. Let's go at this slowly, right? So calculate how much you have on, how many days of cash you have on hand today. Maybe it's 5. Let's set a goal for the next month. Let's get that up to 8, and then to 10, 12, and we will just work our way up of building up our checking account little by little until we get to this number. Us being able to do that is going to put us in a lot better position. And the reason that that the other reason, the unintended, or maybe the untangible, we can't really, I guess, describe it a whole lot, but the other reason that we recommend that businesses would have their days of cash on hand is that we find that businesses just perform better if they have cash on hand. And you're like, well, my business really doesn't care how I perform if I have, $10,000 in the bank, or if I have $22,000 in the bank. I'm still going to have the same number of customers coming through my door. I'm still going to sell the same number of things, right? I don't think so. And so again, this is where this becomes kind of a little bit less tangible. What we usually tell business owners, and if you are a startup or you're a business owner who's gone through these phases of business, is that when you are battling that cash flow in your business, it's pretty consuming. And so the analogy that has been used for years and years and years is that, we've been talking now for 18 minutes, and probably nobody who is listening to this has thought about the breath of air that they've taken in the last 18 minutes. However, now that I've said that, or if for some reason you were restricted on being able to breathe, that's all you're thinking about. The same thing happens in your business, is that if you've got plenty of cash sitting in the bank, you don't think about that part of your business. If you're trying to figure out how to get enough cash in the bank to cover payroll on Friday, or to cover the rent payment next week, that's all you're thinking about in your business. And so what it does is it distracts us from the operations of our business, where we're purely focused on cash flow. So that's just why we see businesses are naturally going to do better if they're not concerned as much about cash flow, and they get there by increasing the number of days of cash that they have on hand. Okay. So that's kind of that down and dirty, looking at that, calculating the days of cash on hand. Now, that's probably the most important thing you're going to learn in all of this lesson that I'm going to teach you, is just have that in mind. How many days can I operate my business, and look at it that way? A few more things that I do want to cover with you today, and when we start talking about these ratios, is a lot of business owners will do something that we call, just kind of like this, down and dirty quick ratio. And what that is it's basically telling me, pulled up the wrong report here. Basically, that's giving me a different vantage point on my health of my business. Again, in order for me to know the health of my business, I'm going to have up-to-date books, and I'm going to have to be able to look at these reports and be able to see that. And if that's one thing that we've learned through the pandemic, is that you having up-to-date books has been critical at almost every different inflection point of this pandemic, whether it was us being able to get PPP funds, or whether it was us being able to apply for loans or get counseling, or all of those things. We needed to be able to look at some financials. And again, for a lot of businesses, this was kind of an afterthought. And that's why Nebraska Enterprise Fund has put so much effort into every small business being able to get access to the tools, to the technology, in order to be able to do this. And that's just why I have to applaud them. So let's say that we have some financials. The next thing that I want to talk to you about is us calculating our quick ratio. And so in summary, what this is that what we're going to do is we're going to look at our assets, again, that can be converted into cash really quickly. And so what we call those are our current assets. So right here, I have my current assets. So, my accounts receivable is going to turn into cash once my customers pay me. The cash I have here, if you had inventory, we can turn that into cash. So here's how much you have in your current assets. For this model, we really don't care about your automobiles, your trucks, or any of your other fixed assets because we can't turn those into cash tomorrow. It's a lot more difficult to sell a skid steer or a truck or a lathe or something like that. That's difficult to turn that into cash. So we look at our current assets. And then what we do is we look at our current liabilities. So our current liabilities is how much do we owe other people? So our accounts payable, somebody gave you a bill, you haven't paid that bill yet. How much do you owe those other people? How much payroll liabilities do you have sitting out there? How much, if your customers went back in this case and they asked for their deposit money back, would you have to pay them back? And so you get your current liabilities. In my case, it's $47,000. Again, I probably should have picked a different company to look at because this probably isn't the typical small business out there. But what we look at is the ratio of those current assets to the ratio of current liabilities. And what we want is we want our current assets to be greater than our current liabilities. Let's say that they're equal. So let's say my current assets are equal to my everything that I can turn into cash is equivalent to everything that I would have to pay out in cash currently. Let's say that those numbers are equal. We would say that that's a 1-to-1 ratio. For every dollar you have available to you, it's got a name to it. And if your small business is at that 1-to-1 ratio, we're probably not living our best life, but it's pretty comfortable, right? It's not horrible. But what we'll often find in startup businesses is that that ratio is actually backwards. Our current liabilities are going to be greater than our current assets. What we owe our vendors is going to be more than the cash we have in the bank and what our customers owe us. And one industry that we see this in a lot in is in the construction industry or in the trade industry, because a lot of times what happens is we get our money up front from our customers, but yet we don't have to pay our vendors for 30 days. So a lot of times there'll be times in our business where we feel cash rich and we might go out and make decisions to spend that cash when we don't realize that kind of that little bit of a ticking time bomb that's coming 30 days from now when you have to go out and pay your suppliers. So we want to always be aware of what this ratio is. And again, the same type of thing is, let's say that you're at a negative ratio. Let's say that your ratio is, you only have 75 cents worth of current assets for every dollar of current liabilities. We're backwards. So again, we're not going to fix that overnight, but you can start to see that if we start to build our cash up, we're solving two problems. We're increasing our current we're increasing our current assets. We're increasing the numbers of days of cash that we have on hand. However, we are becoming more and more healthy in our business because we can essentially satisfy all of those current liabilities as we're growing our current assets. Once we see really, really healthy businesses, we'll see those businesses for every dollar of liabilities that they have, they'll have $2 of current assets to go ahead and satisfy those. If we're getting into those ratios, we can feel pretty good about what's going on inside of our four walls and inside of our business. Again, business doesn't get there overnight, but through just kind of looking at this on a monthly basis and kind of doing our ratios, seeing are we getting better or are we getting worse, you'll stay on top of it, and pretty soon the financial health of your business is going to become a lot clearer, right? The other thing that we would look at in terms of looking at ratios is I might look at my accounts receivable ratio. So how many days of accounts receivable do I have as it relates to my overall revenue? So for example, if I've got $148,000 worth of receivables, and let's say that my annual revenue is $1 million. See if I did that right. 48. Yeah. So what I can see there, I'll bring the calculation over here to you in just one second. So if I take, if I have $1 million worth of revenue and I divide that by 365 days, that's $2,739 on average of my daily sales. I take $148,000. Sorry, we're getting a little nerdy here. And I divide it by that. So let me just walk through this math that I did. Let's say that we do $1 million worth of revenue a year. I divide that by 365 days. So essentially, my revenue here is $2,700 a day. On average is how much I bring in every day. Well, I have $148,000 worth of receivables that my customer owes me. I divide that by my average days worth of revenue, and you can see that I have 54 days of receivables. So essentially, I have 54 days of my sales are tied up with my customers. Depending on your industry, that could be good, that could be bad. I would say for most small businesses, that's going to be bad. So what we want to do is, again, we want to keep in mind, you're going to take your average daily sales and you'll have you'll take your accounts receivable and you're going to divide that by your average daily sales. And it's going to come up with this days of receivables that you have on hand. So what's our goal in our business? To drive this number down. Okay. So whereas I want my days of cash, I want to grow, my days of receivables, I want to have it come down. And what we would expect in most businesses is that maybe that if we could get that closer to 30 days, that means that our customers, once they receive their invoice for us, on average is paying us in 30 days. Okay. With this scenario, they're not paying us for 54 days. We probably have a problem in our business to where we haven't set expectations with our vendors in order for them to pay us on time or in a timely manner. And essentially what that is doing is that's consuming the cash that you have in your business, and it's causing some heartburn and some headaches for you because your customers have your money sitting in their pocket. It's awfully hard to pay your bills or your staff or whoever if that's the scenario. So that's when we talk about days in accounts receivable is what we would do there. Now, we're going to keep in mind the same number that our average daily sales. So the next thing that we would want to look at in our business is how much inventory do we have on hand? Okay. So if you had a balance sheet or if you counted all the inventory you have on hand, we would do the same type of equation on that. So let's say that I had $90,000 worth of inventory sitting in my shop. And I would divide that by my average daily sales. And you can see roughly that I have 32 days of inventory on hand. Okay. So what does that mean? That if I stop buying inventory, theoretically, now this isn't going to be in the real world, but theoretically, if I stopped buying new inventory, 32 days from now, I will have sold everything in my shop. Again, that's a theoretical, right? So you know, chances are that customer that comes in and all the shelves are empty probably doesn't want that one last widget that you have. So that's why that's theoretical. But we would want to look at that and we would want to assess that based upon your industry of, is that good or is that bad? So for example, if I owned a restaurant and I added up all the food I had in my restaurant and it added it up to 32 days worth of my sales is sitting in food in my restaurant, well, I would say that that's probably pretty horrible, right? Chances are everything that walk in is going to be spoiled in the next 32 days. I'm going to have a lot of shrinkage in my company. Wouldn't you expect a restaurant to maybe only have 4, 5, 6 days, maybe 7 days tops, because there's a lot of dry goods of inventory on hand. So that way that inventory is always turning over, right? So we see that we, we would want to see that number 6-7 days. So that number is always turning over. However, let's say that you're a specialty retailer, and from the time you order your products to the time that they arrive to you. So let's say that, I don't know, we sell car audio equipment. We have a car audio superstore. We're selling car audio equipment. We buy our speakers and all that stuff from our supplier in China. We place an order. It takes 60 days for that order to land on our dock. You can see that if I had 32 days worth of inventory, I might be in a little bit of trouble because it's going to take me 60 days to replenish that. Now, I use both extreme ends of that, but we want to keep that in mind of what that looks like. So in this, what we talk about with this is almost like riding a tightrope, because if we drive this number down too low, what that means is that you're going to not have, more than likely, you're going to have items that are out of stock. And so when your customer comes to your store, they're not going to find what they're looking for, and that's going to hurt your sales. If you have that number too high, let's say that we're a boutique clothing line, right? If I have this number up here in the 70, 80 days, which is not uncommon, what we're going to see is that we have too much inventory on hand, and clothing is not considered perishable, but the designs are, right? So we have different seasons. And so if you've got, 90 to 120 days worth of inventory on hand, what that means is that you're going to still have shorts on your shelf when people are wearing coats. So we have to kind of balance that out a little bit and be able to determine what that right number is for us and look at that to make sure that it makes sense. In talking with so many business advisors, they often say that, I just wish our client got this one concept, because there's always this thought that if we buy more and more inventory, that's a good thing. Well, we've got to balance that with our sales or our anticipated sales, so that way we can turn that inventory over at whatever the appropriate rate is for our particular industry. So that's kind of what we look at there. So again, just kind of a high level overview. We wanted to calculate the number of days of cash that I have on hand. How long can I run my business if I didn't have another dollar coming in the door? Then I looked at, hey, can we calculate this kind of current ratio? What are my current assets over my current liabilities? And what's my health look like there? And if you have merchandise that you stock in order to sell to your customers, how many days of that stock do you have on hand? And I think if we think about that inventory in that way, it's going to change how we purchase inventory. And again, I'm going to say the same thing over again. I can't tell you exactly what that number should be for your business, but we need to kind of have it be something that we balance that tightrope of not running out of things, but not having things that are going stale or out of style, so on and so forth. So not to scare anybody on the extreme end of this. So years and years and years ago, and it has held up, is that the average retailer, if you stock 100 items, right? So staple type items, Coca-Cola did this study, if you stock 100 items, and if you are missing one of those items, right? So we didn't reorder it. It's not available when the customer wants it. On average, that's going to be somewhere near a 5% decrease in your overall sales. Logically, we'd think, well, our sales would just go down by 1%. It doesn't work that way. Coca-Cola did a huge study that if you're out of one item out of 100, your sales will drop by 5%, just because you're going to have customers who are looking for that item that don't buy other items, so on and so forth. So we want to just have to balance that tightrope there a little bit. What I'm going to do is I'm going to open this up for questions. We got a few more minutes here. And so I want to make sure that we have the ability to open this up for questions. And then if it's going to let me, I am going to, it will not let me attach this to it. So what we'll do is I will send a workbook over to DoSpace, and they will send out a copy of this workbook to anybody who wants it. We can have that go out there. Normally in the chat, I can attach something there, but it's not looking like that feature is available for me today inside of this. So with that being said, there will be a follow-up email from this where we'll give you a PDF version of the workbook. I'm going to open it up for questions. So if you would like to use the chat function in here, you can type those questions. If you want to unmute yourself, ask those questions. We'll stick around and we'll hopefully be able to answer those for you. Thank you so very much for sticking around for us.
Jacob, I have a question.
Yeah.
What is the best way or steps a business owner could start to plan if they don't have days of cash? And I know you've gone through quite a bit of this, but what if they, just right now, they just heard this for the first time and they want to be able to start planning to have days of cash and maybe it wouldn't be just, maybe it's just that maybe they don't have any days of cash at this point, but how would they get started doing that? I mean, how would that happen?
So let's say, I'm going to give you maybe a case study of an average business, right? That maybe our books aren't up to date, so I can't go through and I can't drill this down exactly. Here's what I would do is I would go print out 4 or 5 of my business bank statements. Okay. And on those bank statements, it's going to tell you how much money came out of that bank statement each and every month. So we know what we're spending each and every month. And essentially what we can do is kind of, if I'm doing that for 2 months or 3 months, whatever I would do is I would just add up how much I spent all those months and I would divide it by the number of days that I'm looking at. So if I was looking at 3 months, divide that by 90. And that's going to give us a rough idea, BC, of how much money I'm spending each and every day. So that's our starting point, is we just need to know how much money our business spends on average every day. And then again, if I don't have financials, I'm just going to look at the bank account and I'm going to see how much money I have. Okay. So divide those 2 numbers and that's how many days you're going to survive. And so, and so that's kind of a down and dirty way of calculating this, that, if we don't have financials to look at, it's a great question, BC. That's how I'm going to do it real quick, is just say, hey, right now you're sitting at 3 days of cash on hand. And to your second part of the question, BC, is how do we start improving that? Well, I think just kind of, finance is weird in that I can give you all the head knowledge in the world, and that's only going to get you 10% of the way there. 90% of it is emotional and just kind of understanding where I want to be, right? So if you take the time to do that calculation and you say, hey, I want in 3 months to have $6,000 of cash sitting in my bank account, because that would give me 22 days or whatever your goal is. You're going to probably have a higher chance of getting there if you know what that goal is than just to never have looked at it. Wow. And so that's kind of how we do it. And like I said, we're going to do baby steps. I'm not expecting most businesses to be able to get there in the next 30 days. That's unrealistic. It's not going to happen. But we're going to set a target and we're going to work towards that target. We're going to get there. We're going to set a target until eventually one day we wake up and we have 60 days worth of cash sitting inside of our business. I've got to tell you, kind of going back to that emotional side of it, that running your business is going to be so much easier if you have that in place than if you don't. And a lot of times what we'll see, again, going back to the emotional side of it, BC, is we'll talk to a lot of successful people and they'll use a term called the floor. And what they'll say is, successful small business owners, is my floor in my checking account is X number of dollars. It's $17,000. I essentially think if my checking account is sitting at $17,000, I have no money, because I know that I have preserved my days of cash for when that emergency happens. I'm going to be okay.
Yeah.
Right. And we know, and probably going a little bit off topic here, but we know that this is an issue inside of small businesses,
Yeah.
that they haven't given it this thought. How do we know that? Because we've seen all of these fintechs pop up and start to rear their head in the last 5 years, right? Because when I start looking at it and I'm at 2 days of cash or 0 days of cash or minus 3 days of cash, I don't know what to do, because I've got to pay my rent, I've got to pay my staff. And so you'll go to a PayPal or you'll go to a Cabbage and you'll go to those different fintechs and you'll get one of those business payday loans, and we just dig ourselves deeper into a hole. And so I know those folks from NEF have seen the results of that with different clients and so on and so forth. So,
right.
yeah.
So would you suggest, and someone just asked, would you suggest that they start off with perhaps trying to just start a little reserve on the side where it's something that they could fall back on? And the reason why I say that, to me, it was a good question, but one of the clients here asked that. But before the pandemic, a lot of businesses did not have those reserves or any days of cash. And so when the pandemic hit, they were like just dead in the water. And then they had to shut down. But those businesses that had a little reserve money, so maybe they didn't call it days of cash, but they had a reserve account, or an emergency account, right? That they were putting money into, which some of them may have had like 2 months, some of them may have had 3 months. And some people thought, okay, I think I can ride this out. Although they had to close, so they lost revenue anyway, but at least they weren't in chaos, trying to figure out, oh my goodness, what do I do next? So when I think of the days of cash, and to help other people that may not really deeply understand it because it's only been less than an hour that they heard about it, I think that it just began to, you know how they always tell you to start having a reserve account for, petty cash if something happens with your car or in your home or something like that. I think that with businesses, there should be a petty cash account or a reserve account. And maybe you start off putting 10, 15, 20, and as your business grow, you add a little more, so now you're putting 100 in or whatever, so that it's like an insurance policy, so that if something does happen, you have some days of cash that you would help you to breathe, and you'd be able to make decisions, as a lot of the businesses were not able to do.
Right.
Just your thoughts on that, Jacob, because
and you said this better than I could possibly rephrase it. Is you use the word chaos, right? So, there's this classic saying that, and we'll refer this back to our personal lives, right? So if we have put some reserves into our personal lives, right? So we have a little bit of savings for the event that's going to happen. For most Americans, and this translates to most businesses as well, when you have an emergency, you actually have two problems, right? So let's say you're at home, your washing machine breaks at home. The vast majority of Americans, when their washing machine breaks at home, they have two problems. I have a broken washing machine, and I don't know how to pay to get it fixed. Mm-hmm. Right? And so we can imagine these businesses that were in the same scenario is when something happened to their business that slammed the door on their business, they had two problems, right? How do I figure out what to do in my business? And then how do I pay for it?
Yeah.
I've got to tell you, and I'm just reiterating what you said, BC, those businesses that only had one problem of how do I fix this? Not how do I pay to fix it, but how do I fix it? Those businesses, by and large, did pretty well because they got to take their whole mental capacity and focus it on coming up with a solution to fix the problem instead of, oh my landlord's going to kick me out next week, or they're going to shut off the lights. That's the problem you're dealing with, not how am I going to find a different way to reach my customers?
Right.
So that's where we kind of said that these intangibles come into it, And I just think that it's so very important. And let me tell you where it even gets better is that if we create that mentality, that kind of that saving mentality. I just had another example of this morning, and it's not that we want to take advantage of situations, but if you are in a position where you are financially sound, you know, in when we did these lessons before, one of the examples I gave was an audiology group that had plenty of days of cash on hand, right? They had really built up their reserves. They were focused on this for years. It took them a decade to do this. So this isn't where we get to overnight, but it took them a decade to get here. And guess what happens? One of their largest device, you know, the people that sell them their hearing aids, those device manufacturers, was coming up on a quarter end, and obviously they weren't going to hit their numbers. So they were looking to dump a bunch of devices into the marketplace. This company went in and had the cash to go in and swoop up and buy their next 6 months worth of inventory. And guess what? They got it 30 cents on the dollar.
Wow.
And so we can see that what that did for their profitability by having that cash on hand really set them up to be able to kind of just prosper in the time where maybe a lot of other people weren't. And so not only is it going to give us security, but eventually it's going to open us up to different opportunities to be able to take advantage of things that happen in the marketplace.
Yes.
You know, your dream, you know, you want to expand your business, and the dream building comes up for sale, and you know it's going to sell right away, and we need to have a huge down payment to go lock that in.
Right.
It's not going to wait around 3 years for you to get that. If you have the cash, we can get on that, and we can grow and expand our business. So that's where we get from that.
I love that. And the thing too is that opportunity is always knocking. So
Yeah.
the thing is to be ready, right? I
Absolutely.
think that's it. I don't see any questions in the chat, Jacob. Does anyone have any more questions? See if they're gonna put anything in. Well, see, that's it, Jacob. You explained it so well that no one have questions now.
Well, very good. Well, I just looked over at who's on the call today, and so some names that I recognize. So it's always good to kind of hear from or to see you all, or to be able to have a little bit of contact with you. And I'm sure that we will continue to do that moving forward. I appreciate the opportunity from Nebraska Enterprise Fund and DoSpace for hosting this event. And yeah, till next time. Thank you so very much.
All right. Thank you, DoSpace, and thanks all of you guys for joining us. You have a great evening. We'll see you next time.
Thank you now.